Welcome to today's Explainer. Today, May 21, 2026, is really shaping up to be a defining moment in the cryptocurrency markets. We're looking at what feels like a massive, structural conflict playing out right in front of us. It's a literal tug of war between old ghosts and brand new financial rails, and it is holding the entire market in total suspense.
Okay, let's dive right into this, because right now, we're looking at a massive market paradox. Over the last few hours, we've seen immense geopolitical relief as the Strait of Hormuz officially reopens to global shipping. The market obviously rallied on the news, pushing Bitcoin up to a robust $78,000. By all traditional logic, traders should literally be popping champagne, right? But if you look under the hood, the market remains completely spooked.
I mean, just look at this. The Fear and Greed Index is currently sitting at a dismal 21. For those of you keeping track, that represents extreme fear. So how on earth can we be trading near $78,000 with a major global trade route reopening, while the market sentiment is practically paralyzed with terror? Well, today we're going to unpack the massive market disconnect causing this.
To untangle all this, we're going to quickly walk through today's roadmap. 1. The 78K market paradox. 2. The German Bitcoin supply shock. 3. Hacks and quantum threats. 4. Institutional plumbing expands massively. 5. Tokenizing SpaceX and beyond. And finally, 6. The metric you must watch.
All right, part 1, the 78K market paradox. Let's start by framing this ongoing clash between geopolitical relief on the surface and severe psychological anxiety underneath. On one side, you've got this massive bullish pull. Middle East tensions ease, the Strait of Hormuz reopens. Boom, global relief rally. But pulling back hard on the other end of the rope is a paralyzing bearish fear. It's this underlying dread of legacy supply risks. Ghosts from the past that could just dump onto the open market and totally crush this momentum.
Which brings us to part 2, the German Bitcoin supply shock. Now, what's really interesting about this is that it introduces the absolute heaviest weight on the bearish side of the rope today. This is the primary threat keeping the market range-bound. We're talking about a looming overhang of $4.4 billion. That is 57,000 Bitcoin, folks. And the source? The German state. There's this proposed court deal in that long-running Movie 2K piracy case, and if it goes through, it drops this crushing amount of Bitcoin directly into the hands of the German government for potential liquidation.
And that creates what we call a state-level liquidation threat. We've seen this movie before, no pun intended. Historically, when government sees massive troves of Bitcoin and start offloading them on the open market, it builds this impenetrable sell wall. It acts as a massive psychological headwind for retail investors who are just terrified of buying into a government dump.
Okay, moving to part 3, hacks and quantum threats. Because honestly, that state supply isn't the only weight pulling the market down. This second part of the bearish pull introduces a layer of digital warfare alongside some highly sophisticated tech fears. First up, we have the Grinex situation. The sanctioned Russian exchange just had to suspend all operations following a $13.7 million hack. But here's the wild part. In a highly unusual move, the exchange actually came out and publicly blamed Western special services, meaning foreign intelligence, for the cyber attack. Now, as an explainer of the data, we aren't here to validate or invalidate the politics behind that claim, but we do need to point out that tossing state-sponsored digital warfare into the mix injects a chilling layer into the current market narrative. It definitely makes investors incredibly nervous.
And then you add in the existential tech fears. Joshua Lim, co-head over at FalconX, put out a technical alert this week about the growing anxiety around quantum computers eventually breaking Bitcoin's cryptography. His main point? If a quantum threat ever becomes credible, you won't see those old, compromised Satoshi-era coins move on-chain first. No way. Institutional traders will ruthlessly, instantly hedge their exposure in the futures market. Derivatives are your early warning system here.
All right, let's flip the script. Part 4. Institutional plumbing expands massively. Let's see how this builds into the bullish pull of our tug-of-war. Because right beneath the surface of all this panic, the utility phase of crypto is accelerating at breakneck speed. The institutional plumbing is getting a massive upgrade.
Just look at this rapid-fire string of institutional wins. First, the Bahrain-based Singapore Gulf Bank officially launched a 24/7 stablecoin mint and redeem service for their institutional clients. Meanwhile, over in Europe, French Finance Minister Roland Lescure just officially backed the Qivalis euro-stablecoin initiative under the new MiCA framework. And finally, in DeFi, the Sky ecosystem, what we used to call MiCA, just deployed USDS natively on the Avalanche network. Guys, think of this as laying down heavy-duty financial plumbing. We're talking about regulated, highly efficient bridges connecting capital from Asia, the Middle East, and Europe straight to on-chain liquidity.
Which perfectly leads us to part 5, tokenizing, SpaceX, and beyond. Because these new rails are actually being used to fundamentally change what we can even trade.
We are literally watching the lines between traditional private equity and digital assets blur in real time. Case in point, just this week, the BTC Exchange launched SpaceX Pre-IPO perpetual futures. That is a game changer. It allows both retail and institutional traders to grab speculative exposure to Elon Musk's aerospace giant completely on-chain, well before the company ever does a traditional public listing.
So, why does this actually matter for Bitcoin's price? Well, when mainstream assets like SpaceX settle on-chain, they create entirely new forms of collateral. It builds out this broader financial ecosystem that operates outside the US Federal Reserve's interest rate ceiling. It basically makes the structural foundation of the crypto market significantly more robust and primes it for protocol-specific rallies totally regardless of macroeconomic fears.
This brings us to part 6, the metric you must watch. We've got intense fear of government supply dumps and quantum hacks pulling one way, and massive tokenized private equity pulling the other. How do we find out who's actually winning?
Just to visually summarize our 78K tug-of-war here, the legacy supply risks are incredibly heavy. I mean, $4.4 billion in German Bitcoin is no joke. But on the right side, the institutional expansion, the global stablecoin rails, the tokenized real-world assets, that represents deep structural buying power. So, the crucial point is this. You must watch the Bitcoin basis trade spreads in the derivatives market. That's simply the difference between Bitcoin's spot price and its futures price. This right here is your practical early warning radar. If we start seeing news about the German court case advancing, but those derivative spreads stay stable and don't crater, that tells you the institutional demand flowing through those newly built stablecoin hubs is strong enough to just eat up that German overhead. The foundations of this market have literally never been stronger, even if the psychology of it all is currently hijacked by fear. So I'm going to leave you with this to investigate for yourself. As extreme fear battles massive institutional plumbing, what is the basis trade telling you today? Keep a close eye on those derivatives, and you'll see exactly where this market is heading next. Thanks for joining me for this explainer, and keep learning.